Hello guys, welcome back to ESENtaxa. I'm Peter here. In this video, I'm going to talk about a general topic of international tax law. And this is extremely important because it's the classical topic that all our clients are facing with. And here in ESENtaxa, with our consultancy services, we have people exactly this kind of issue, especially to relocate to a specific country. And we understand how to help people to the tax burden, optimize taxes, and of course, analyze the convention to avoid double taxation between two countries that we are examining. And in this today's video, what I want to talk about is the method used by two countries to avoid double taxation. So basically, in order to avoid you to pay taxes twice on the same income. Now, let's break it down. The concept is very easy. So imagine you are moving to a specific country and you're earning income from the country of origin. So you're going to be a new resident tax-wise, a new resident, and you keep your rental income from your property to detain your country of origin. This is a classical situation. Now, it happens quite frequently that the country wants to tax this income, the new country you're moving to wants to tax this income, but also the country in which your property is located won't tax that rental income. So how do you do that? How do we deal with this kind of situations? How do we avoid double taxation situations? Because both countries want their slice. Now, it's very easy. Countries, between them, they sign what is called DTAA. It's Double Taxation Agreement Avoidance. It's a very long name, but it's very simple. Basically, it's the way in this document is written the exact method to avoid that you get taxed twice on the same income. And in general cases, all over the world, all the countries agree to one method that could be, in general cases, either a tax credit method or exemption method. Of course, we might have hybrid situations and different, let's say, hybrid situations. So some countries might use both methods, some other countries use only one, and some other countries apply the mirroring principle or reciprocity principle. It means that if you country A use with my income the credit method, I'm going to also use the credit method and vice versa. What is this credit method? The credit method is very simple. It's the principle that allows you to tax your foreign income, but allows you also to subtract, under the form of credit, your income coming from abroad. The previous example, abroad means the place where your home is located. So the country where your home is located tax your home by 10%, for example. But the country where now you're located, for example, wants you to be taxed on worldwide income. So this new country wants you to declare all your income worldwide. You have to declare this rental income, won't tax that rental income at 20%. So when you invoke the tax credit method, you simply subtract the 10% taxes already paid before and then pay on the difference to this new country. While some countries apply the exemption method. This is extremely advantageous in certain situations. Exemption normally means that it doesn't matter that the other country taxes the same rental income, as long as this country taxes it, I don't tax it. See? So it means that you're a new citizen, a new tax resident guy that has income from abroad, you declare everything from abroad, so you fulfill my requirements. And since you have already been subject to that income under taxation, I will do it from myself. And this is the exemption method. Of course, there are some variation of the exemption method where you have exemption with progression, full exemptions, or, as I said before, hybrid situations. Now, if you are in this situation, if you want to analyze your convention to avoid double taxation with your country region versus the country you're moving to, you're relocating to, let us know, because in the description below the video, we provide you this service. We provide you the consultancy service, 20 minutes call, 1 hour call. We analyze the convention, and we're going to tell you exactly which are the methods used between your country and the country, your country of origin and the country you're moving to. Okay? In this way, you can correctly declare your income and apply the full and correct amount of tax to pay. Don't give for granted the fact that a certain country always use the credit method, always use the exemption method, because it's not always the truth. Also, the type of different income might change the method used by the country. So, for example, if you're using employee income, right, some countries use the exemption method, but the same country might use the tax credit method when it comes for dividend, or doesn't use the exemption, neither the credit method, it uses still another different method that could happen. So be careful about this point. If you want to know more from us, from ESENtaxa, in the description below the video, you have our email contact info@esentaxa.com. We can help hundreds of clients with this kind of issues. And for anything else, if you want to be updated for free with our content, just subscribe to the channel, notification bell, like button to help us grow as a channel. And see you in the next one.